The second phase of the housing market collapse has now commenced, signaling a substantial reversal. Sellers are significantly reducing prices, and rising mortgage rates are causing a surge in price cuts. It's not a matter of if, but when. Watch till the end to uncover the red flags indicating the housing market's impending downfall and what you can do to prepare for the upcoming housing market crisis. This shift is poised to transform the market dynamics, especially with growing inventory levels alongside declining demand, marking the pivotal moment warned about by experts. Fewer home purchases are being made while more properties are hitting the market, resulting in noticeable supply and demand imbalances across various regions. The situation has become precarious, where any sudden shock could trigger a disastrous scenario. Recent data from real estate listing firm Zillow highlights a significant increase in home price reductions, particularly in the hottest markets of 2021 and 2022. In fact, Zillow reported that more homes have experienced price cuts this year compared to the past 5 years, with nearly 99.2% of home listings seeing price reductions in September, a considerable rise from the 7.9% rate in 2019 for the same period. Make sure to subscribe to The Financial Scoop and leave us a like below this video. Furthermore, Redfin's latest housing market update disclosed that approximately 1 in 15 homes in the U.S. market witnessed price drops last month, a rate significantly higher than previous years. Certain cities are experiencing even higher rates of price reductions. For instance, in Memphis, Tennessee, the share of homes with reduced prices spiked to 22.6%, marking the metro area with the largest year-over-year increase in home price cuts. Despite the rapid increase in the frequency of price cuts, the market remains at a standstill. Data from the Mortgage Bankers Association indicates that potential buyers are increasingly disengaging. Mortgage application volumes hit the lowest point since 1999 in the third quarter. Shockingly, after the unprecedented surge in demand throughout 2021, monthly applications have plummeted by over 82%, marking one of the most significant declines ever recorded. Throughout 2021 and 2022, soaring demand kept prices high. However, this year, buyers have started to withdraw, contributing to a consistent and accelerated decline in demand quarter after quarter. Redfin's data indicates that the demand for homes is nearing the lows witnessed during the pandemic. Several factors contribute to this decline, with mortgage rates standing out as one of the most influential, currently approaching the 8% mark. According to Freddie Mac, the average 30-year fixed mortgage rate reached 7.63% last week, the highest level in nearly 23 years. This translates to a monthly payment of $2,528 for a median-priced home with a 20% down payment, a staggering 91% increase compared to 2 years ago, adding $1,244 to monthly mortgage payments. Housing affordability has consequently reached its lowest since 1984, demanding 40% of the median household income for the average home payment. Andy Walton, Vice President of Enterprise Research at ICE Mortgage Technology, notes that this situation is a drastic change from the past years, when low interest rates inflated home prices to around 6 times the median income. With the Federal Reserve's ongoing rate hikes, driven by the goal to reach a 2% inflation target, the situation is forecasted to persist. Despite the prospect of mortgage rates reaching 8%, the current unaffordability of homes will persist, leaving buyers priced out of the market. Nicole Butcod, senior economist at Zillow, highlighted that a buyer making the median household income and putting a 10% down payment on a typical home in August would have allocated nearly 40% of their income towards mortgage payments. To bring this figure down to the recommended 30%, a standard benchmark for affordable housing, significant adjustments are necessary. The issue lies in the fact that the median household income currently stands at only $74,500. If mortgage rates were to rise to 8%, Bassett stated that the income needed to afford a typical U.S. home would increase to around $114,000. Buyers are already facing a challenging situation, and the housing market is unlikely to change significantly with rates exceeding 8%. Given this highly restrictive scenario for buyers, the plummeting demand becomes evident. The situation might become even more turbulent during the upcoming winter. The declining trend in demand is already noticeable in many markets, although it hasn't substantially altered the national average just yet. For example, Austin and Houston in Texas experienced median price declines of 5.9% and 1.6%, respectively, in September. Similarly, Tampa, Portland, and Phoenix witnessed home prices dropping by 1.3%, 1.2%, and 0.4%, respectively. To maintain or increase prices in the coming months, the supply of homes must match the low levels of demand. The housing bubble of the past years was fueled by a shortage of homes and a surge in demand. However, the current issue is vastly different. Demand has dwindled to a point where there's limited room for further decline. Conversely, new home listings indicate that supply is growing and surpassing initial expectations. Zillow revealed a burgeoning surplus in various markets. Nationwide, new home listings rose by 4% in August and reached the highest level since February and September. This rise in supply, coupled with weakened purchasing flows, has led to a continuous increase in the total count of active inventory. Data suggests that both buyers and sellers have little choice but to reduce asking prices due to the declining competition. The market is cooling off remarkably fast, even during this typically slower time of the year, according to Zillow analysts. As sellers start to panic and flood more inventory into the market despite falling demand, supply can increase exponentially, leading to substantial price cuts and market instability. However, in today's market, a crash doesn't necessarily need a dramatic increase in inventory. It hinges more on how low the demand plummets, which currently seems to be heading to all-time lows. During this phase of the housing market reversal, the challenges can be exacerbated by low liquidity, making it difficult to swiftly buy or sell a home. Unlike the stock market, where transactions are rapid and asset values are relatively stable, the real estate market involves numerous variables. Companies and investors assess a home's value based on previous sales in the area, and a change in one property's price can affect the value of surrounding homes. For instance, a neighbor selling their home for more or less can influence the value of your own property and numerous others in the neighborhood, potentially causing market fluctuations and financial challenges, particularly during the upcoming winter. We've surpassed the speculative phase where investors and large corporations take advantage of low interest rates to buy family homes, aiming to sell them later at higher prices. Typically, these entities, often paying in cash, engage in bidding wars, capitalizing on the fear of missing out during the initial bubble stages. As properties become scarce, families, left with no choice, reluctantly accept higher costs. Speculators then begin reaping profits. However, when demand reaches a peak, the turning point begins. Sellers realize they can't elevate prices further due to a lack of buyers. At this stage, any economic disruption could swiftly alter market perception. If investor sentiment turns negative, triggering a rush to sell, a crash might ensue. While the labor market hasn't collapsed yet, credit tightening and anticipated rate hikes could lead to increased unemployment rates, potentially altering market perceptions. Various other factors could also go wrong, as noted by John Tuig, the head of whole loan trading at Raymond James. The combination of unusually high interest rates and inflated home prices is abnormal. Recently released data on mortgage delinquencies and foreclosures is adding to sellers' anxiety. Mortgage delinquency rates have risen, while serious delinquencies, defined as 90 or more days past due, have increased significantly. Foreclosures are also escalating, intensifying sellers' concerns. Rising inventory no longer supports the exorbitant housing prices. Sellers are in a difficult position, facing potential massive losses if they delay action. The final stage starts when buyers, who purchased homes at inflated prices, struggle to meet mortgage payments, leading to stressed sales, triggering further price drops and a downward spiral. Investors begin to panic and sell off properties to escape the deteriorating market conditions, resulting in sellers undercutting each other. This scenario mirrors the 2008 housing market crash, where home prices plummeted by 27%. Bringing affordability back to long-term averages might require a substantial decline in home prices, a potentially devastating situation. The stage is already set, and signs of an impending market downturn are prevalent. All that remains is waiting for the trigger to be pulled. These observations are indicative of a challenging market situation. Thank you all for watching. Please make sure to subscribe to the channel and leave us a like below this video. Let us know what you think about the current housing market crisis below.